Thanks to everyone for joining us. My name's Gavin Martin. I'm from Cornerstone Wealth. We're running the How to Transition to Retirement webinar this evening. It's the second in the series of 3. And Phil Watson, the Digital Marketing Coordinator from Christian Super, is going to intro this session for us. So thanks, Phil. Really appreciate you giving up your evening to at least intro the session.
No worries at all, Gavin. And I just saw that Karen is the first webinar for you, so special welcome to Karen and all the others who have joined. So let's kick it off by praying. We're a Christian Super, so we love to ask our God in heaven for help. So join with me in doing that. So Father God, thank you for Monday nights and this chance to learn a bit about our retirement. Lord, we know that you only have good plans for us, despite ourselves. It's all because of your goodness. Lord, we just ask for your wisdom as well as Gavin's wisdom, and we just ask for your help to ask the right questions and for Gav to have the right information. And we just ask that we even during this webinar, we'd get a touch of how good you are to us and get a sense of what you have in store for us, all because of your Son Jesus. In his name I pray. Amen.
Amen. Thanks, Phil. Really appreciate that. It's important to note that tonight's presentation is advice of a general nature only, and please seek personal advice before making any decision. If you do want to seek personal advice from us, then you can certainly do that. The process that we normally take you through is to have you complete a questionnaire first. We then meet with you for an initial consultation, and that's about understanding your goals, what you're trying to achieve, looking at your current situation, and talking through the pros and cons of the range of options. We also normally include there projections of what your particular circumstances might look like, and to find that quite useful for people approaching retirement and also early in retirement, to get an idea of will they have enough to live on longer term. So that's an effective mechanism for that. We can also give you personal specific recommendations in the form of a statement of advice, help you implement it, and provide ongoing monitoring and review as well. But you can take this process as far as you need to or want to. There's going to be 3 main areas that we're focusing on: salary sacrifice and the transition to retirement strategy. And what should you do if you've already got the transition to retirement strategy in place? What should you change if you have, or should you change anything? So one of the key and one of the most beneficial strategies that you can apply is the salary sacrifice strategy, and that's where you forego income being paid into your bank account and have your employer direct it to your superannuation. And the key thing is the tax saving. So I'll just talk through how that works and then try and explain the benefits of it and how to work out how much, if any, you should salary sacrifice if you can. So salary sacrifice is, if you're not salary sacrificing, then basically your employer deducts some withholding tax or PAYG taxes deducted, and then the remaining amount is put into your bank account. From there, the rate at which they deduct the tax is based on rules, but it's largely aligned to what your income is and what tax you're likely, or income tax you're likely to pay throughout the year. And these are the marginal tax rates. So from about 20,500 up until 37,000, you'll pay 21% tax. From 37 to 87, it's 34.5%. From 87 to 180,000, you pay 39% tax, and then above 180,000, the tax rate this financial year is 47%. So that's the sort of rates of tax that you'll pay if you take your salary as income into your bank account. Once it's in your bank account, then you can spend it or give it or put it into your super or save it. So you can do what you want with it, but effectively you're paying these sorts of rates of tax. In the case of a salary sacrifice arrangement, your employer, before they deduct any tax or pay money into your bank account, they deduct a smaller amount of tax because they firstly direct money to your super account, and then that means that you've got less taxable income, and so less PAYG tax is deducted. And then the remaining amount, after some money has gone into your super, is paid into your bank account. Now, the key point here is that the contributions tax amount that you put into your that is charged when the money goes into your superannuation account is less than the amount that you pay in withholding tax, or ultimately pay when you submit your tax return. So the difference between your marginal tax rate and the contributions tax rate is the benefit of salary sacrifice. And so if we look at that, we can quickly see that there's an arbitrage difference there that can be of great benefit. So, and it can be of multiple thousands of dollars of difference depending on your particular situation. The difference between 15% and 21% is 6%. So you get a 6% benefit on any salary sacrifice that you're making into superannuation. If someone's earning if you're earning between $37,000 and $87,000, your marginal tax rate's 34.5%. So any salary sacrifice amount is going to save 19.5%. So if on $10,000, for example, that's $1,950 of tax saving. If you're on the 39% tax bracket, then the saving is 24%. So the difference between 15 contributions tax rate and your marginal tax rate is 24%. If you're on the 47% tax rate, then the difference is 32%. But if you start to earn over $250,000, then your contributions tax rate increases to 30%, and then the difference is only 17%. But this is the key difference, or the key benefit of the salary sacrifice arrangement, that you are able to save tax, and these are the rates of tax that you are able to save based on your taxable income each year. Now, this year, there has been a change to the rules, so you don't actually have to salary sacrifice to take advantage of this strategy this financial year. What you can do is, if you haven't salary sacrificed, or previously if you weren't salary sacrificing, and it's like June, just before the end of the financial year, for example, there's no option for you to salary sacrifice income because you've already been paid all of your salary for the year. In the past, you haven't been able to take advantage of your concessional contribution limit. But the rules have changed this year, which means that even if you haven't salary sacrificed throughout the year, you can make a contribution from some of your savings to your superannuation account and claim a deduction on it, which has exactly the same effect as salary sacrificing throughout the year. So this year, the 2017-18 financial year, there is more flexibility around making contributions to super in order to save tax. I'll try and just explain that for you. So under a salary sacrifice arrangement, which I've just explained, the benefits of it are that you can actually do it on a regular basis. You can set it up with your employer. The amount is deducted from your salary on a monthly or fortnightly basis, depending on how regularly you're paid, and it's almost set and forget. It's good if you have known your tax situation, and but even if you do take advantage of the salary sacrifice arrangement and you haven't quite got to your threshold amount for the year, which is $25,000 this financial year, you can still use the personal deductible mechanism for saving tax. Sometimes employers are really irregular with the way that they make contributions to super, which can make it difficult when you're salary sacrificing, because you don't have to make them as regularly as you need to make, or employers generally make superannuation guarantee contributions, the 9.5% that your employer needs. So if an employer is not as consistent with timing, then sometimes personal deductible contributions can work well. Some employers don't allow you to salary sacrifice, so that's where personal deductible contributions are useful. If an employer, and often this is government employers, reduce the superannuation guarantee when you start to salary sacrifice. So if that's the case in your particular scenario, then making personal deductible contributions is better than salary sacrifice. And where your employer is irregular with their payments, or you have an planned tax liability, so you've sold an asset throughout the year and you hadn't been salary sacrificing and you've got some space left in your contribution limit for the year, then you could potentially use personal deductible contributions. And also if you're self-employed or have a self-employed position, then personal deductible contributions can work really well as well. So they end up with the same outcome, but they're just different mechanisms for achieving that outcome. Just with personal deductible contributions, I'll just explain that it is a little bit more precarious in that when you make salary sacrifice contributions, they're already in a form that what we call salary sacrifice or concessional contributions. Tax is already, the 15% contributions tax is already deducted from it, and there's nothing further you need to do. When you make personal deductible contributions, you're firstly generally making what we call a member contribution. So you're putting in, let's say, $50,000 into your super before the 30th of June. You need to do it before the 30th of June. It's based on a financial year. And then you need to submit an ATO form, which is an intent to claim a deduction form. So if we've contributed 50 grand, the maximum amount that we can claim is a deduction of 25. So on this form, the ATO form, we're saying that we've made 50,000 of contribution, we're going to claim, and it's up to $25,000. We need to submit that to their super fund, and then you need to get a confirmation from your super fund that they've received it and they've claimed the amount up to $25,000. 15% tax will be deducted on that, and then afterwards you can submit your tax return. What I'm trying to emphasize is if you go down this track under these more flexible rules that have started from the 1st of July 2017, you need to make sure that you don't make any rollovers, withdrawals, or submit your tax return before claiming that deduction, before submitting that deduction and getting the confirmation. So just really important that you understand that if you go down this track rather than utilising the salary sacrifice mechanism. So what are the benefits of salary sacrifice? Or you could substitute salary sacrifice with personal deductible contributions or other types of concessional contributions. Now, the benefit of salary sacrificing is that the formula that you can use is your marginal tax rate plus the Medicare levy less the 15% contributions tax times the amount that you're salary sacrificing. So if we've got Ben who's 60 years of age, he's earning $70,000 in taxable income and he salary sacrifices $10,000. So in Ben's case, the benefit to him, so the annual benefit to him would be his marginal tax rate, which is 32.5%, plus the Medicare levy, take 15%, times $10,000, which gives you 19.5% times $10,000, which is $1,950 benefit. He could actually probably make a greater benefit, but we've just made it nice and round. For every $10,000 that he salary sacrifices, he can save nearly $2,000, and that's on an annual basis. So you can see where this is a very common strategy that all financial advisors review when they're trying to maximize client situations. Really good to do. Sometimes when you're in certain thresholds, that benefit, the $1,950 benefit, can be increased by the low income tax offset. And if you're over 65, soon to be 65 and a half, you can also get access to a $1,600 rebate of SAPTO, which is the Senior Australian and Pensioners Tax Offset, which brings up the low income brings up the tax-free threshold as well. So the benefit is pretty clear. You can save significant amounts of tax on an annual basis. David asks, can you top up if you didn't contribute the full 25 last year? Can you go over the $25,000 this year? Not this year, but the year after it you can. So from the not this financial year, but from 1st of July 2018, you can start to accrue a balance if you don't utilise your full $25,000 contribution limit. It's called the catch-up provisions, but they're not starting, so you won't really get a benefit until the following year after that, actually. So it's going to be in the 2019-20 financial year that you'll be able to utilise any unused concessional contribution limit at that point, but not this financial year, sorry David. So now we understand the benefit. It could be for every 10,000, it could be between $2,000 upwards in benefit. So you can see the benefit. So when should you do it and when shouldn't you do it? Firstly, it's not right for everybody. If you've got debt, particularly if you've got consumer debt, I wouldn't be salary sacrificing. I'd be paying off credit cards and personal loans before I'm salary sacrificing. But when you've got mortgage debt, if you're, we generally prioritise paying off mortgage debt. But if you've got a mortgage well on track to be being paid off and you're approaching your preservation age, getting close to 60 for example, or even 65, and you've still got some mortgage debt, sometimes we say, well, you can actually save so much tax that let's hold off, just keep your regular mortgage repayments and plough some money into super with the idea that you're going to be able to take a chunk out of super shortly and save the tax along the way. But if you're a young person in your 20s or early 30s, for example, and you're not going to be able to touch your super for a long time, we often focus on paying off the mortgage, not salary sacrificing. But it's a balancing act, particularly if you're on a high tax bracket. So focus on debt first. It depends on your tax rate as well. So what we're trying to do is pay tax at no higher than 15%, and this relates to, I've forgotten whose question it was, but how much should your salary sacrifice down to, particularly if on 25,000 for example. So it's not always beneficial to salary sacrifice, depending on what your marginal tax rate is. You've got to make sure you stay under the contribution limits, which is $25,000 this financial year. And you've got to make sure you've got sufficient cash flow. There's no point salary sacrificing, saving all this tax if you can't afford to live. You need to make sure that you've got sufficient cash flow. The transition to retirement strategy can actually benefit that a lot of the time. So if you have got cash flow problems and you've reached your preservation age, then consider the transition to retirement strategy that we'll focus on in a minute. And then also access to super, similar to, I think it was Grant's question or David's question, that you may not want to focus on ploughing a lot into super if you're going to be focusing, or you've got a cash flow needs in the short term and you've got a long time before you can access your superannuation. So it's a point you need to consider as well. So I'll walk through a few of those issues now and try to explain those in a little bit more detail. Christine asks, can you recommend a company who provides salary sacrifice services? Oh, really good question. When you actually are salary sacrificing, I was recently speaking to a fringe benefits expert who had a few recommendations for that. So maybe if I don't come back to you, Christine, maybe email me later. But generally when you're setting up salary sacrifice, you're just doing it with your employer. So most employers facilitate it rather than using a salary packaging company to do it. So you just ask your payroll person, or if you're in a school, your bursar or business manager to salary sacrifice a certain amount each pay. Often that mechanism is done by the employer and not outsourced to a salary sacrifice company. But if you are looking for a salary packaging type company, then email me and I can give you a few recommendations. Grant says, if you use personal deductible method, does your tax return the difference between your marginal tax rate and the 15 or 30% rate as a refund? Yes, it does. And that it basically achieves the same outcome as salary sacrifice, but you'd get a refund at the end of the year as opposed to reducing your tax throughout the year. Michael says, 25k limit includes employer contributions. Yes, it does. Yep, and I'll reinforce that in a minute. Thanks, Michael. Fiona asks, is the contribution limit relating to the super that is paid in by your employer or what you put in yourself on top of that? It's both, and I'll explain that more. Grant says, thanks. Pleasure, Grant. So I'll try and explain these in a little bit more detail now. So how much should your salary sacrifice? Now, what we're trying to do is make sure that we pay tax at no higher than 15%. That's because the contributions tax rate on these types of contributions is 15%. So if our marginal tax rate is higher than that, then we should utilize salary sacrifice if we've got the cash flow to do it. So marginal tax rates, if you're earning an income between 0 and 18,200, then your tax rate is 0. That's the tax-free threshold. When we also include the low income tax offset, of $427, I think it is, then that brings that tax-free threshold up to about $20,500. So if your taxable income, so your earnings from employment and interest on your bank account and other investments is less than $20,500, then you'll be paying no tax, and so there's no benefit in salary sacrificing. If your taxable income is $20,500 or less, you'll actually be paying more tax than you need to. You'll be increasing your tax rate from 0 to 15%. So don't salary sacrifice your income down below $20,500. You'll be paying more tax. But if your taxable income is greater than $20,500, then your taxable income, including the Medicare levy or your marginal tax rate, is 21%. And so therefore, there's an arbitrage of that 6% between the contributions tax rate. So let's walk through an example. And similarly, your marginal tax rates are, if 37 to 87, it's 32.5%. Without the Medicare levy, if you include a Medicare levy, it's 34.5%, and so on. You can see the rates there. So let's use an example. If my income was $40,000, then it would be good if we salary sacrificed $19,500 to get our taxable income down to $20,500. We paid no income tax at all. We'd pay 15% contributions tax on the $19,500, but even after that contributions tax, we'd save $2,000 in tax. So even on that $40,000 income, we'd be saving $2,000 by making that $19,500 salary sacrifice amount. But the point here is, don't go below the $20,500 taxable income. Now, as I mentioned earlier, this is if you are under 65. When you are over 65 and potentially have access to SAPTO, Senior Australians and Pensioners Tax Offset, then that brings the tax-free threshold generally to $29,000. So if you're over 65, then just factor in that, because you might be eligible for SAPTO, Senior Australian and Pensioners Tax Offset. So the second point about how much to salary sacrifice is making sure you don't exceed your contribution limit. And a few of you have just asked about that. What is included in that $25,000 concessional contribution amount? Well, it includes superannuation guarantee, salary sacrifice, and personal deductible contributions. So if I'm on a salary of $115,000, for example, and the limit is $25,000, the concessional contribution limit is $25,000, people often assume that, I can then salary sacrifice $25,000. They put it into the super account, but the problem is they haven't factored in the superannuation guarantee contributions that their employer has put in of 9.5%. And on $115,000, 9.5% is $10,025. And so they would have gone, if I did this, I would have been, in my circumstances, gone over the threshold by $10,025, and I would have paid a penalty for that. Now, it's not massive, the penalties, but it's a 6% of the amount that you've gone over for at least 12 months up until you submit your tax return. So it might be $600 penalty. So it'd be better off not to do that. So remember that the $25,000 limit includes your superannuation guarantee contributions. So what you should do is reduce the salary sacrifice amount by the superannuation guarantee contributions. In this case, it's $10,025, and we put instead $14,075 into the super account in salary sacrifice contributions, and save $3,378 in tax. So you can see how you need to make sure that your $25,000 concessional contribution limit includes all of these three things: your employer contributions, salary sacrifice, and personal deductible contributions. Another thing that we often trips up people is employers that, as I mentioned earlier, employers that pay their superannuation contributions a little bit irregularly, sometimes a June payment can hit your account in July, and then if the next year they don't do the same thing, you can end up unexpectedly going over these $25,000 thresholds just because your employer's been a bit irregular in when they make their contributions, and they've gone into one financial year and not in the previous financial year. So you need to balance that out as well, and that's a case for personal deductible contributions where your employer is a bit irregular in their payments into your super, because it's actually what's hit your account. It's not what your employer has deducted from your account that matters when you're talking about exceeding your concessional contribution limits. So we've talked about salary sacrificing, not going beyond your tax-free threshold that is $20,500. We've talked about not exceeding our contribution limit of $25,000 this financial year. The other thing is that we need to make sure that we don't make ourselves cash strapped, as in we need to be able to afford from a cash flow perspective to do this as well. So let's have a look at an example here. If we've got $115,000 salary, again, we salary sacrifice $14,075, but let's say that means that we haven't got enough money to pay for our expenses. There's an income gap. Now, what we could do is we could reduce our salary sacrifice, for example, by $10,000, but we'd be missing out on say $2,400 in tax savings. So it's probably not the best outcome. What you can do in this scenario is try to look for other sources of income to make up that difference. So still go back and salary sacrifice the maximum amount, but try to fill that income gap with other sources of income. Now, that might be a cash reserve that you've got. Often people have some savings that they've retained that they could use to make up the income gap. Another way to do it is to use some pension income, so money from your superannuation that you've moved to pension phase to supplement that income. If you're over 60 years of age, that income is tax-free and means that you're actually saving tax on the salary sacrifice but drawing tax-free income from your superannuation. That's called the transition to retirement strategy, and we'll go into that in a bit more detail. So that's salary sacrifice. You need to make sure that you don't pay more tax than you need by salary sacrificing too much. You need to make sure that you don't go over your contribution limits. If you do, it's not the end of the world, but ideally you do stay under those limits because there are penalties, even if they are minor penalties. And then you need to make sure you can meet your cash flow requirements. One way of meeting your cash flow requirements is by setting up what we call a transition to retirement strategy. Now, the concept of this strategy was instigated by Howard and Costello back in 2006-07, and it was relating to the simple super changes. So that was the last time we had significant changes to superannuation, and 10 years later we've just had some other significant changes to super. What they did was they allowed you to access your superannuation without retiring, because people were retiring to access their super, but they had to give up work fully rather than go part-time to be able to access their super, which meant people were exiting the workforce prematurely. They saw that as a long-term problem and enabled people to access their super at their preservation age rather than having to fully retire. So people could scale back work, work part-time, and use superannuation to supplement their reduced income. But one of the upsides was that you could actually continue to work full-time and get an even better or greater benefit from the strategy. But with the federal budget being under pressure and continuing to go into more and more debt, the government's looked to find ways to reduce or increase the tax revenue, and one of the ways that they've decided that they'd do it is starting to tax the earnings on transition to retirement pensions, but also reducing that concessional contribution limit was either 30 or 35, depending on your age, down to $25,000. So there's two ways that the transition to retirement strategy has been, or the benefit of the strategy has been reduced, but there still is benefit in pursuing the strategy depending on your circumstances. Now I'll try and explain that in a little bit more detail. So the benefits of the transition to retirement strategy are threefold. One is the salary sacrifice, as per the previous slides, but you can implement salary sacrifice independent of the other two benefits. The other two benefits are that you receive tax-free income from your superannuation if you're 60 years of age, or it's concessionally taxed if you're between 55 and 59 years of age. So that's the second benefit of a TTR strategy, transition to retirement strategy. And the third benefit is that the tax rate in the pension phase is 0% tax versus 15% tax in the accumulation phase. Now this is where the benefit has been pulled back. And if you just note over here that a condition of release is required for you to access that 0% tax rate in pension phase. So people who have already got a transition to retirement pension in place and were previously paying no tax on the earnings, they'll automatically, if they haven't satisfied a condition of release, their accounts will automatically start to be taxed, or the earnings on the accounts will be taxed at 15%, similar to an accumulation phase, unless they satisfy a condition of release. Now the benefit of being able to satisfy a condition of release on a balance of say $500,000 is that if that $500,000 was earning 5% or $25,000 in income and it's taxed at 15% versus 0% tax, that's a $3,750 benefit if you were able to get to the 0% tax-free pension phase of superannuation. So it depends on your circumstances whether or not you've met a condition of release and can access that 0% tax rate in your superannuation. If you've not met a condition of release, then the TTR, your transition to retirement strategy, is what we call non-commutable, which means that you can't draw lump sums off from it, but you can draw up to 10% of it each year. So if the balance is $500,000, then you can draw $50,000 of it, and that's where you can free up some cash flow, even if it's not in the 0% tax rate environment, but it's even if you still might be paying 15% tax on earnings, but if you can access $50,000 of that balance tax-free, for example, if you're over 60, because you want to pay off your mortgage or you want to salary sacrifice more, then it's still a beneficial strategy to pursue. So they're the threefold benefit of the transition to retirement strategy. It's been reduced this financial year, but there is still benefit in it depending on your circumstances. Fiona asks, how can you be taking out of super in a pension at the same time of putting in? Shouldn't you be saving as much as possible in super when you need it later? Yeah, good question. What you're doing is you're cycling money in and out of your superannuation. We're saving tax by putting money into our super tax effectively, and we're drawing money out of our superannuation, particularly for over 60, tax-free. Now ideally we don't use that money and we can then just recycle it back into superannuation or other savings. So overall we're ideally building up our assets and we're just using the superannuation structure to achieve that. Fiona says, follows up with, so can you be in accumulation phase as well as pension phase at the same time? Exactly, you can, and I'll explain that more with a diagram shortly. Eddie asks, what is a condition of release? I'll come back to that in shortly, Eddie, so just stay tuned for the next couple of slides. So Fiona, this is how a transition to retirement strategy works practically, and I've got an example of someone with an accumulation balance. Accumulation is where you're putting money into the superannuation account. In this case, the balance is $200,000. So what you do is you leave $5,000 in the accumulation account and you roll over the remaining balance to a pension account. So now you have two accounts, an accumulation account with $5,000 in it, and a pension account with $195,000 in it. With your accumulation account, you can continue to put money into it. So a personal contribution, or what we call a non-concessional contribution of $1,000, depending on your tax rate, you might be able to put into your super, and the government might give you a $500 co-contribution. It'll go into your accumulation account. Your employer contributions will continue to go into your accumulation account, as will any personal deductible contributions that you're making as well. Salary sacrifice and personal deductible contributions go into that accumulation account. Now, there are minimum amounts that you need to draw from your pension. If you're between 55 and 65, you've got to draw a minimum amount of 4% of the balance. So 4% of $195,000 needs to be paid out of your pension account, into your bank account. Now, this is where this payment here can help with the surplus, the income shortfall if you're salary sacrificing, the money that you're drawing out of your pension. If you're over 60, that money comes to you tax-free. If you're under 60, so between 55 and 60, it comes to you not tax-free, but it comes to you concessionally taxed. But it is of greater benefit when you have turned 60 and these payments out to your bank account are tax-free. If you don't need this money, as per relating to Fiona's question, if you don't need this money or you just want to save it, you can just put it back into your superannuation again. Now, the key difference between last financial year and this financial year is that investment growth, you get investment growth on both your accumulation account and your pension account, but this is where things have changed from the 1st of July this year. Depending on whether you've satisfied a condition of release, the investment growth on this account, on your pension account, will either be tax-free or be taxed at similar to the accumulation account. And we'll go into a bit more detail about that. Adrian says, I have a transition to retirement plan and turned 60 in January 18. I've been advised to discontinue a pension top up then, and in January put a lump sum in that would have been the equivalent as if by month. This means that I get a pension tax-free. Is this smart? Adrian, you don't necessarily need to stop your pension, but you need to not take any more pensions until after you turn 60. This is a common and a good strategy. You don't pay tax on your pension when you're 60, so if you don't take a pension between now and turning 60 in January, so you might see your pension payments to start in February, then you won't pay tax on the amount that you draw out because you're 60 and you're receiving your pensions then. You're receiving your pension payment then. So you either roll back your pension to the accumulation phase, or you can leave it in pension phase and just set your pension to be paid after you turn 60. In these next couple of slides, we're going to talk through what you should do if you've currently got a transition to retirement strategy in place, but we'll also talk about the condition of release for those of you that are trying to work out what a condition of release is. So you need to, if you've got a transition to retirement strategy in place, you need to decide whether you're going to start a pension, stop a pension, or reboot your pension. Now, this is the preservation age that I mentioned before. So the age at which you can access your superannuation money is based on your date of birth, and based on your date of birth, your preservation age is either 55 through to 60 years of age. So check out which preservation age yours is, and remember that, because that's the age at which you can access your super in some format. And depending on whether you've satisfied a condition of release or not, that will determine whether you can access lump sums from your super or whether you can only draw a pension, and it also determines whether you can have tax-free earnings on your pension money as well. So the first step is access to super is based on preservation age. Check out which one yours is. The second, just one other point, is that the new rule from the 1st of July 2017 is that you can only, oops, I've just gone backwards rather than forwards. that there is a limit within your pension phase of superannuation of 1.6 million. There also is another separate limit that once you've reached 1.6 million in super totally, you can't put any more into super unless it's for small business or you've sold a business or it's a personal injury compensation payment. Also, this may relate to you, Peter, if you've got a defined benefit, is that defined benefit pensions also are given a capital value to the value of 16 times the annual pension amount. It's not exactly worked out just based on that annual pension amount. There's a different formula, but it's basically reflecting an annual pension amount. So we're saying if we've got a defined benefit pension that's worth $60,000 a year, 16 times that is $960. If you've also got an account-based pension of $700,000, that means that you're over the $1.6 million threshold and you'd need to roll back $60,000 of your account-based pension to the accumulation phase or withdraw it fully from superannuation. So that's just another rule, a new rule that starts from the 1st of July. It doesn't impact you unless you've got balances up around that $1.6 million mark. But now, just reinforcing that from the 1st of July, any earnings on transition to retirement pensions, sometimes called non-commutable account-based pensions, changing from tax-free to 15% tax. So if you have or are thinking about starting a non-commutable account-based pension, I'll just walk through how that will work and how the tax will work in that particular scenario. So similar to what we talked about before, a $200,000 accumulation account, we've rolled over $195 to the pension phase. In the accumulation phase, the investment growth is taxed at 15%. So if you've got a $5,000 balance and it earns 5% on that $5,000, you're going to be taxed at the tax for the year will be about $37.50. Now, depending on whether you've satisfied a condition of release or not, it'll depend on whether your investment growth is tax-free. So previously it was tax-free, but from the 1st of July, it'll be 15% tax. And this is the benefit. So on $195,000, the tax might be around $1,400 to $1,500 depending on the earnings levels. And so how do we work out now whether you've satisfied a condition of release? Now, a condition of release, you firstly need to have reached your preservation age, and then there are 3 different types of ways that you can satisfy a condition of release. The first one is if you are less than 60 years of age and you have ceased gainful employment, and there is a second condition that you need to satisfy, which is you need to have state that you never intend to again become gainfully employed. So you're under 60, you've stopped work fully, you're not working part-time, and you declare that you're not going to you don't intend at that point in time to return to the workforce. Now, you can in the future return to the workforce, but it needs to be your intention at the point in time that you make that declaration that you're not going to return to the workforce. If that is the case, you've reached your preservation age and you're under 60, ceased employment, and you don't intend to return to the workforce, that means that the investment growth on your pension account will be then taxed at 0% rather than 15%. Now, it doesn't happen automatically. You need to tell your superannuation fund if that's the case. If you've got a transition to retirement pension in place and you've ceased employment and you don't intend to return to the workforce and you're under age 60, you need to tell your superannuation fund that that's what's happened. Otherwise, you'll continue to be taxed at 15% on that account. Now, there is a second condition of release. If you've turned 60 years of age, there is not the requirement to say that you're not going to return to the workforce. You intend to never return to the workforce. So you might have you've turned 60 and you might have 2 jobs. If you cease one of those jobs, you've ceased a form of gainful employment, which satisfies a condition of release. And therefore, again, earnings on your pension account can be tax-free, but you need to tell your superannuation fund about that. And then the final condition of release is a catch-all. So you've reached preservation age and you've turned 65 years of age. The 65-year age limit is your catch-all. If that's the case, then your superannuation, your pension phase account will be having tax-free earnings. So that's what a condition of release is. With this new rule that only if you're satisfied a condition of release can you that you can get these tax-free earnings, there's a greater emphasis on this condition of release. So understanding it and applying it and letting your superannuation fund know when you have satisfied it is important, because it can be saving you multiple thousands in tax. So then you need to decide to whether you're going to start a transition to retirement pension or an account-based pension, or if you've got one in place, whether you're going to stop it, whether you're going to reboot it. This last slide here is trying to help you decide. So what type of pension do you have, or what type of pension could you have? So if you haven't started one already, what type of pension could you have? So will it be a transition to retirement pension, which is taxed at 15%, or will it be an account-based pension because you've satisfied a condition of release and it's taxed at 0%? That will these types of things that you need to ask yourself to work out whether you commence or stop or reboot your pension. Reboot means that you recombine your superannuation accumulation account with the pension account. You would do that for a number of reasons. It can help you draw more money from your pension account, particularly if you're looking to pay down your mortgage, for example. But it can also mean that you can get more money across into the 0% tax rate environment. So have you satisfied a condition of release under those 3 rules that we just talked about? If no, if you haven't satisfied a condition of release, then you're only going to be able to set up a transition to retirement pension, or remain in a transition to retirement pension, and the earnings are taxed at 15%, the same as same as an accumulation account, your standard superannuation account. So the only reason that you might set up one of these accounts is if you need the cash flow. So you might be able to draw out, particularly if you're over 60, you might be able to draw out money from that transition to retirement account, tax-free if you're over 60, concessionally taxed if you're under 60, but often it's less compelling if you're under 60. But if you want a salary sacrifice and you can't do it unless you draw some money from your super, then often it is worthwhile commencing a transition to retirement pension just for the cash flow, so you can save that multiple thousands of dollars on your salary sacrifice to superannuation. Another reason, something that you need to factor in, particularly if you're under 60, are the tax components, because how tax effective the drawings are from your superannuation account depend on your taxable components within that account. So you need to, that gets a little bit more complex, but you don't need to worry about that tax components if you're over 60, but if you're under 60, then you do need to factor that in, because it means that it might not be that tax effective to be commencing a transition to retirement pension. And particularly with these new rules of 15% tax on earnings, if you're under 60, it's becoming less and less compelling to commence them. You also need to factor in CGT relief. That's a little bit more of a complex strategy, but generally if CGT relief will be applied to your account automatically from the 1st of July if you were in a transition to retirement pension previously. So that's if you haven't satisfied a condition of release, you're not going to get the benefits of a 0% tax environment. You're going to be in a transition to retirement pension, and mainly it's focused around cash flow. The benefit of is cash flow. If you have satisfied a condition of release, one of these 3 conditions of release, then you can commence an account-based pension, which means that you can get into that 0% tax rate environment, and it is definitely beneficial in most cases to move to the pension phase, because you're just moving from a 15% tax environment to a 0% tax environment. And so, yeah, think about your particular scenario and determine whether you should start a transition to retirement pension, or if you can, start an account-based pension, or if you're already in one, should you stop it or should you reboot it? And it depends on your particular scenario. Now, I've probably raised a few questions with that, and I have, so thanks for that. I'll try and address those now. So Richard asks, I don't need the money. Is there any benefit in changing my super from accumulation into pension phase if I'm still gainfully employed part-time? I'm over 60. Well, there is a benefit if you have satisfied a condition of release, as in one of these three conditions, because you can move your super account into this 0% tax environment. Even if you don't need the money, if you need to draw more money, you've got to draw the minimum amount from these accounts. But if you've got the ability to put that money back into superannuation, then just getting access to the tax-free earnings is generally worthwhile. So if you have satisfied a condition of release, Richard, then it generally is. Elizabeth asks, so do you need to tell the fund if you're over 60? If you're simply in the accumulation phase and and you're not moving to pension phase, then there's no need to tell them that you're over 60. But if you've moved to the pension phase and you haven't satisfied a condition of release, they don't mind. They don't need to know. You don't need to tell them if you're over 60. But if you have, if you are moving to the pension phase or are already in the pension phase, the transition to retirement type pension, then you need to tell them if you've satisfied a condition of release, as in you're over 60 and satisfied, ceased gainful employment, or you're under 60 and you've ceased employment altogether and don't return to the workforce. And the reason for that is that you can then change your account from a transition to retirement pension to an account-based pension that's tax-free. Michael asks a very good question, what is gainful employment? Now, under the SIS guidelines, gainful employment is working more than 10 hours a week. So if you're working less than 10 hours a week, gainful employment is working in the financial year. If you've worked 40 hours in 30 days, you've satisfied the work test to get money into superannuation. But your question is more about what's gainful employment. And so if you're trying to satisfy a condition of release and, for example, you're under 60 and you've stopped work, you can actually declare that you don't intend to become gainfully employed again if your intention is that you don't plan to be employed for more than 10 hours a week. So I think that's what your question is, and it's a key measure about whether you're gainfully employed or not, or whether you intend to be gainfully employed or not, because it's a 10-hour-a-week definition. Good question, Michael. Does changing to part-time from full-time with the same employer count as gainful employment ending? That's a very good question, and it depends. Often if you're just changing from full-time to part-time, it doesn't satisfy a condition of release because you actually haven't ceased work, you've just reduced your hours. But if you ceased work, retired, got all your long service leave and annual leave paid out, and were on, you weren't working with that organisation for a time, and then they asked you to return as on a part-time basis because they needed some assistance, as in they wanted to re-employ you, then that would be you've satisfied a condition of release because you've ceased work and then you've come back on a part-time basis. But you can't simply just change to part-time generally and satisfy a condition of release. You really have to finish up, cease the employment and then recommence either with the same employer at a later point in time, or a different employer would make that easier. Elizabeth asks, sorry, once you reach 65, once you reach 65, once you reach 65, then the super fund should automatically change your transition to retirement pension to an account-based pension. But it would be worthwhile checking that too. Thanks, Elizabeth, for that question. Bill says, I've turned 65. I think you've followed on with another question. Is my standard superannuation taxed at 15? If so, should I transfer it to pension account? Yeah, your standard accumulation account is taxed at 15%, and that is one of the main benefits of moving to the pension phase, is that you're moving from a 15% tax on earnings to a 0% tax on earnings. And if you look at the Christian super differences on earnings between accumulation phase and pension phase, generally it's about 50 to 60 basis points, or 0.5 to 0.6%, which is around, on $500,000, it might be around that $3,000 to $4,000 of annual savings by moving to pension phase. So generally it is well worthwhile. Adrian asks, so I have a $60,000 mortgage and about $300K in super. Can I use the super to pay off the mortgage when I turn 60 in Jan? Am I right in assuming the earnings on the super will be tax-free? After you turn 65, the drawings from your after you turn 60, the drawings from your superannuation are tax-free. That's what I was talking about earlier, Adrian, that when drawing money from superannuation when you've turned 60, that it's tax-free. But you would need to satisfy a condition of release for the earnings on that 300K in super to be tax-free. You can still, without satisfying a condition of release, draw up to 10% of the balance from that super if it was moved to pension phase. So a balance in $300,000 rolled over to pension phase, you could draw 10% of that. You could, if someone who's over 60 can draw that money tax-free. So you might be able to draw $30,000 from your superannuation tax-free, but it doesn't mean that the earnings on the remaining $270,000 will be tax-free until you have satisfied a condition of release. Fiona asks, but if you are gainfully employed, how can you say that it has ended? But if you are gainfully employed, how can you say that it has ended? Well, you can't be gainfully employed. Well, depends on whether you're asking about the under 60 and reach the preservation age and cease gainful employment, or whether you're talking about 60 years of age. When you're 60, you just need to cease some form of work. It could be 2 jobs, you cease 1. If you're under 60, then you need to have ended gainful employment, and you don't intend to be gainfully employed again, which is you don't intend to be working for more than 10 hours a week throughout the year. David asks, hi, I've satisfied a condition of release, but some significant other income from investments. Is pension phase earnings tax-free, or is it only earnings, or is only the earnings tax-free? Is the pension phase earnings tax-free, or is only the earnings tax-free? I think that's the same question, but when you move from, if you've satisfied a condition of release, the earnings within your pension account are tax-free. Oh, actually, you've followed up with another question. The earnings in the fund tax-free. Yes, the earnings within the fund, if you've satisfied a condition of release and you've let your superannuation fund know that you've satisfied a condition of release, you'll have an account-based pension. They will define it as an account-based pension, and the earnings then are tax-free, 0% tax on earnings. Bill asks, I'll just go back to the other question. Is my standard superannuation tax at 15%? If so, should I transfer to pension account? Then there's another if so. If so, do I need to withdraw at least 4% annually? Yes, if you move to 4%, if you move to pension phase and you're between 55 and 65 years of age, you need to draw the minimum amount of 4%. You've got to draw at least 4% of the balance annually. Yes, that's correct. Between 65 and 75, you've got to draw 5% of the balance, and over that it just increases at different age thresholds. Paul, g'day Paul, thanks for joining us. Is an account-based pension available before reaching age 60 if retired? Seems not with Christian Super. Yes, an account-based pension is available before. That's just all about satisfying a condition of release. If you've retired, you've under age 60, but you've reached your preservation age, so you're now 56 or above, then you've ceased gainful employment, you don't intend to become gainfully employed again, which means that you can commence an account-based pension, which has earnings tax-free. You can do that within Christian Super, yes. Thanks for the question, Paul, and thanks for joining us. Fiona asks, so if you intend to continue working, you cannot start a transition to retirement pension because you can't satisfy the condition of release to get money out of super in order to put it back in. No, that's not correct, Fiona. If you haven't satisfied a condition of release, you can still commence what we call a transition to retirement pension, or otherwise called a non-commutable account-based pension. And you can access up to 10% of that balance each year. You've got to draw a minimum from it. But the drawback of it is there's no savings, there's no tax savings on the earnings on the account. So the only reason you would do that is to access some funds from the account. You wouldn't do it to save tax on the earnings on the account, because you're taxed at the same rate as your standard accumulation account. Peter says, God bless, thanks Peter, pleasure. James asks, not about releasing pension dollars, so happy for you to answer this question later. When I retire in January, I will be given 6 months worth of long service leave as a lump sum payment and obviously be taxed on this money. Can I put this into my super and pay less tax on it this financial year? Is there a maximum amount you can deposit? Yes, there's a couple of points there, James. I think you're the last question on my list at the moment, so I'll answer it because I'm just going to move into question time afterwards anyway. So there's a couple of things to factor in there, James. One is what your age is. So are you over 65 years of age, or are you under 65 years of age? So that's a key question, because that impacts whether how much you can put into superannuation. Another question is, are you eligible for the age pension, or have you reached your age pension age and are you eligible for it? Because when you're taking long service leave as a lump sum, okay, also you've said that you're 63 years of age, James, thanks for that. When you're taking long service leave as a lump sum, employers are not obligated to pay the superannuation guarantee on that long service leave. So if somebody's under age pension age, and they're not going to miss out on age pension by taking long service leave over time, often what we do is rather than taking long service leave as a lump sum, we request that you actually defer your retirement date until after you've taken your long service leave, which gives you an additional 9.5% superannuation guarantee contributions that you wouldn't otherwise get. Taking it over time gets you that extra 9.5% if your employer's happy for you to take your long service leave and annual leave over time. Sometimes employers are amiable to actually paying the SG, so the superannuation guarantee of 9.5% on the lump sum, but they're not required to. So if they aren't prepared to do that, often we take long service leave over time. And then the final question is, can you put the money back into super? And depending on what your taxable income is, the answer is yes. Under that, you could either arrange them to salary sacrifice, your employer to partly salary sacrifice, up to that $25,000 threshold, as long as your taxable income is still over that $20,500 figure. Stephen says, thanks for the session, most helpful, my pleasure. A different Stephen says, thank you and see you next webinar. Yes, great, Stephen. The next webinar is about, it's a little bit more focused. It might not be relate to everybody, but it's talking about capital gains tax if you've sold an asset and minimising that capital gains tax, and also about maximising your estate or maximising the benefit to your beneficiaries in the event of your death. And it's talking about a cash out recontribution strategy. So it goes into a little bit more detail, a bit more, and it might not apply to everyone. But the two webinars after that are about Centrelink. So the first one is basic Centrelink questions, and the second one after that is detailed Centrelink strategies. So in the next three webinars, often find are pretty useful for people. So yeah, thanks Stephen D. For your comments. Keep your questions coming if you have them. I think I've got through all the slides that I needed to get through. Sorry we've gone a bit over time, but I have been answering your questions as we go through. I'll now just walk through the questions that were asked when you registered for the webinar. But if you have questions live, then I'll prioritise those. So feel free to keep them coming live, because I'll focus on them. So Eddie asked the question, best way to avoid capital gains tax on selling our house, which we have rented for the last 23 years out of 25 of ownership. I'll go into that in a fair bit more detail in the next webinar, where we talk about minimising capital gains tax. It's largely through either selling in a low income year and making contributions to super, to personal deductible contributions to super to minimise your tax. That's in big picture how we manage that. Graham and Lorraine ask, better to finish paying a house off or put money into super? It's a balancing act. If you're close to your age at which you can access your super, that's your preservation age. Often we start to focus, balance a little bit by focusing on super, because you can access your superannuation soon, and you might as well save the tax and then access a lump sum from your super. But if you're a long way from being able to access your super, then we focus on paying off the mortgage. Glennis asks, can it be that having your own investment working for you be more profitable than putting money into super? It can be. It largely depends on the differences in return. But often we encourage you to, if you can access the same investment inside of super as outside of super, and there's more concessions from a tax perspective inside of super, then generally we would say put it into super and invest in that more effective or more profitable investment within super, because at some point in time you'll be able to pay no tax on it, particularly if you can get it to that 0% tax pension phase. Jennifer asks, couple each on disability support pension age 61, 400k in super. Do you have any strategies for this case? I do. So strategies in that scenario is making sure that you don't come off the disability support pension. If you're 61 years of age, then your superannuation account will not be assessed for Centrelink purposes, so you could potentially move some of the 400k to pension phase, but you need to make sure that you don't move too much, because you don't want to go over the lower asset test threshold, which would cause you to lose a disability support pension. But you can potentially move some to pension phase obtain access both to the 0% tax environment, but also access a little bit of extra cash flow if that's what you need as well. So a couple of strategies there, but you need to really manage them tightly. Roy asks, a healthcare card and support from Centrelink. Tune into not the next webinar, but the following two after that. Rosalind asks, how can I collect enough to retire sooner rather than later? These strategies that we talked about are really the key to that. So the other strategies that we'd add on to that would be, if you're eligible for the spouse contribution and government co-contribution, consider those as well. Fiona asks, how can spending part of your super during transition to retirement be good? Doesn't it mean that you will have less to live on later? Not if you save the money that you're drawing from superannuation or utilising it to salary sacrifice and save tax, like we've talked through in the webinar. Vangel asks, how do I access my super after retirement? You can either, if you've satisfied a condition of release, you can draw lump sums from your either accumulation phase or your pension phase. You've just got to submit a request to do that. Often there can be benefits in moving to pension phase. There's no withdrawal fee, and depending on your circumstances, it might be tax-free free drawings. Eric asks, how do I get the most benefit out of my smallish super balance in 5 or more years' time? Key one is salary sacrifice if it's applicable to you, and consider these transition to retirement strategy that we've talked about, government co-contribution, spouse contribution, those types of strategies. Yulene asks, how do the government changes on the 1st of July affect my transition to retirement now and in the future as I'm still working full-time? Now your decision will be, do I maintain the transition to retirement strategy because I need the cash flow and it helps me salary sacrifice and save tax in that way? Or do I not worry about the transition to retirement strategy and roll the account back to my accumulation account? That will be your key question there, Yulene. Or am I able to satisfy a condition of release and get it to the tax-free pension phase, turn it from a transition to retirement pension to an account-based pension? And if you can do that, then that's great because you get tax-free earnings on the account. So before I go to the next screen of questions, I'll just check any other questions. No, Richard's just saying thank you, a pleasure, Richard. Just continuing on with a few more questions. How soon can I transition to retirement? So the key date is your preservation age. We talked about that earlier. It used to be 55 years of age, but for people this year, you'd be turning 56 years of age to reach your preservation age. Lois asks, how do I make the most of what we have in super? Applying the transition to retirement strategy, salary sacrifice, spouse contribution, co-contribution are the key strategies. Marianne asks, I am 3.5 years younger than my husband. He is 61, I am 57. Can I take his super so that he can get a pension? Yeah, that's an effective strategy. Depending on your earning levels, holding superannuation in the younger spouse's name, because it's not an asset assessed by Centrelink, can mean that the older spouse can access the age pension or more of the age pension when they are pension age. We talk about that strategy in 3 webinars time, where we go into detailed Centrelink strategies. Lynn asks, I'm turning 60 later this year. Is there anything that I should be particularly doing regarding my super at this time? Yeah, it would be considering whether or not to move to pension phase, particularly if you've satisfied a condition of release. But even if you haven't satisfied a condition of release, you can be drawing money from your super tax-free, and so if that enables you to salary sacrifice or pay off your mortgage, it's often something well worth considering. Michael asks, I was born in 1957. The pension has limitations in relation to retirement age. At what age can I receive the pension? Good question. I'll have to look up my chart, or if you just go to, you can just go to the My screen's I just need to get my pen back. And if you go to the Human Services website and search on age pension, you'll see the age pension eligibility ages, if I can type properly. And so just search on that page and it will give you the eligibility criteria for the age pension, which includes age rules, includes the age at which you can access the age pension. So if you check out what your date of birth is, it was 1957. So if you're born in 1957, then the age pension age is 67 years of age. So hopefully that answers your question there. Who was that? That was Michael. Age pension age for someone born in 1957 is 67 years of age. That's the government age pension. Robin asks, I would like to retire before I am 67, retirement age for me based on the Australian age pension. So how can I do that? The key thing there is to make sure that you've saved enough to live on, because you'll be self-funding your retirement prior to 67 years of age. So when you are fully reliant on your own resources, you do eat into your resources more than if you have a part age pension being paid. But as long as you've saved sufficient funds, then retiring earlier than your age pension age of 67 is fine. Often you can just move your accumulation account to pension phase to access those monies. Sharon asks, I'm 61 and have 3 different super funds, all with small amounts. How can I prevent fees eating the capital? The key thing is consolidating them all into a single account, which will reduce your fees. Just make sure that you factor in any insurances. If you've got insurances that you want to retain that are across the 3 of them, transfer the insurances into the chosen fund first and then roll over the balances to that chosen fund so that you both retain your insurances and you have eliminated or reduced your fees on the accounts. Greg asks, I'll be 58 in December 2017. What do I need to do to work toward either part-time or full-time retirement, and when? I guess that's all about projecting forward what income you need. You could move to part-time income, and you could use some of your superannuation to supplement that income if your part-time income isn't sufficient for you cash flow wise. But you do need to plan out the longer term and get an idea as to whether doing so will mean that you still have enough for your longer term retirement. Diane asks, I am on part-time contract, salary sacrificing and an option, or is salary sacrificing an option? Yeah, definitely salary sacrificing, or this financial year you don't have to salary sacrifice, you can just make personal deductible contributions instead of salary sacrificing. Terry asks, if I plan to retire in 10 years, what risk level of super should I be in? That's a good question. That's about investment options. There are 5 investment options within Christian Super. If you have a long investment time frame, and generally we're saying a long investment time frame is 7 to 10 years, then you can choose the higher risk options. So generally someone with 10 years until retirement would either be in what we call the My Ethical Super or Ethical Balanced option. The My Ethical Super, which is the equivalent to the Ethical Growth option, which is a 70-30 portfolio, 70% in risky assets, 30% in defensive assets, or you might be one notch down, so you might be in the 50-50, so 50% in risky assets and 50% in defensive assets. One thing you can do if you're a Christian Super member is log into your member account and check out Christian Super Equip, which is like a robo-advice type calculator. It helps you determine which investment option would be suitable for you. It's based on 6 basic questions, but it can help you try and decide which investment option is the right one for you. No more questions live coming through, so I'll continue on with the non-live questions. Bill asks, I'm already in transition to retirement plan. Will it still work for me? Yeah, we've largely covered that off in this webinar. If you didn't catch the webinar, go back and revise it, because we've really tried to help you determine that. James asks, lump sum or pension? Lump sum or pension really depends on so many different circumstances. There is a case now if you've got large amounts in super with these new transfer caps, as in only $1.6 million being able to be moved across to the pension phase, that you should draw the minimum from superannuation, minimum pension amount, so 4% if you're between 55 and 65 years of age. Only draw that minimum as a pension and draw the rest of a lump sum, so it reduces your transfer balance cap for pension purposes. But it's getting a bit complex. I really don't know what you're trying to ask there, James, so follow up with more questions if I haven't covered that off. Greg asks, option for using super after retirement. Key one there is if you've retired, moving it to pension phase, having tax-free earnings, tax-free drawings if you're over 60 years of age is the key method for utilising super in retirement. Peter asks, paying off mortgage and retirement living. So paying off your mortgage, yep, great to focus on. Retirement living, I'm not really sure what you're requesting there. Many people, I forgot to mention, many people had questions around how much do I need to retire, when can I retire? Those questions were addressed a lot in the initial webinar, the retirement planning webinar. So go to cornerstonewealth.com.au/Cornerstone Wealth. Sorry, not Cornerstone Wealth. I'll start that again. cornerstonewealth.com.au/retire 2017, and that will give you all of the webinars that we're doing on the retirement planning series, but including the initial webinar that talks about how much do I need to retire and when should I retire. Brett says, reduce mortgage or add more to super. I think we addressed that for a number of other people, but the closer you get to your preservation age, the more that we would focus on super. The longer you are away from your preservation age, the more that we focus on the mortgage. Roger says, removing debt, depending on your age and whether you've satisfied a condition of release or reached your preservation age, then utilising some of your super money could be a way of removing debt or reducing debt. Elizabeth asks, should I continue with my current transition to retirement strategy when my income is less than 50 grand a year? It depends on whether you've satisfied a condition of release, whether you need the cash flow. I think we've addressed it largely throughout the webinar. Karen asks, should we be paying more off our mortgage per month or saving this extra payment? I think you should be paying off your mortgage. Is definitely, if it's non-tax deductible, as in it's just against your home that you're living in, paying off your mortgage, it's pretty hard to beat. Phil asks, to sell or not to sell a property or properties. We're going to talk about that a little bit more in the next webinar, but it's mainly around not whether to sell or not, but whether to how to save capital gains tax on the sale of those investments. Yeah, it's pretty hard to answer that question in a meaningful way, Phil, without knowing any further details, so feel free to make contact if you want more details. Mark asks, understanding options with accessing my super. I think we've explained that a little bit this evening, so review the webinar if you haven't been online. And I think there's just one more lot of questions to get through before signing off. So Chase asks, understanding transition to retirement, how to start implementing a plan. I think we've largely covered that off. Tessa asks, what are good options for investing once salary sacrifice cap of 25k per annum is reached? Yeah, good question. We haven't addressed that. Well, you can actually put more money into super under your non-concessional contribution limit. So there's not the tax savings, but you can still get the money into super if that's better. If you've got someone or if you've got a low taxable income, then you can invest it in your own name. If you've got a spouse who's on a low taxable income, then you could invest in their name. Or if you're a long way from your reaching or being able to access your superannuation balance, then you could potentially utilize a trust to distribute to church and charitable organisations. Although the Labor government has introduced a policy to pull back on that. So the range of different options there, hard to go into a lot of detail. Gregory asks, what do I need to be contributing to superannuation at this point in my career? I don't know, because we don't know your circumstances, but the thresholds that you can salary sacrifice up to is that $25,000 per annum at least. Philip asks, what do I need to do to claim my pension once I actually retire from work? Well, it depends on which pension you're talking about. To move from accumulation phase with your own super to pension phase, you've got to complete an application form that you can either access from the Christian Super website or call up and they'll post you a copy. If you're talking about the age pension, to access that, you've got to either give them a call or apply online. That's how you access that. Ron asks, what financial options are there as I intend to transition from full-time to part-time work? We've largely covered that off in the webinar. Bill asks, what is the most helpful financial preparation for moving from part-time to full-time to part-time work or voluntary work? And very similar questions there, Ron and Bill, after turning 65 years of age. The preparation is really about making sure that you have all your entitlements. So at 65, you've satisfied the condition of release. Holding most of your superannuation in the pension phase of superannuation is good because it's tax-free earnings. If you're over 60, all drawings from it are tax-free. And you just need to make sure also that you're making sure that you're accessing the age pension or maximising the age pension if you're eligible for it under the income and assets test. Marianne asks, when and how do I draw from super after turning 60 transition? So the way that you access your super after turning 60, if you're still employed, is via a transition to retirement pension. It's a matter of completing an application form and posting it off to Christian Super. Peter asks, when to start withdrawing money from super at age 60? Depends on your particular scenario, but if you need the cash flow or you can pay down your mortgage, then just moving to pension phase can mean that you can start drawing on your super tax effectively. Pierre says, will I have enough capital on retirement day, and is there a way that I can buy back more years of superannuation? No to the latter question. I don't think you can buy back more of your superannuation, but you can work out whether you will have enough capital on retirement. You can either use calculators. There's one on your member online via Christian Super. We do it in a comprehensive way in an initial consultation, or there is also things like the government's Money Smart website that also has some calculators that can assist with that too. The final question is Colin's question, which is, with a small mortgage to pay at age 65, should we use superannuation to pay out the mortgage while interest is low? I tend to think that at age 65 it's best to pay down your mortgage, even if interest rates are low and the superannuation earnings have been high in the past. There's no guarantee that they'll be high in the following years. They may be negative, you just don't know. So we tend to take the conservative approach and pay down the mortgage. But as like all responses to your questions, tonight's advice is advice of a general nature. You need to seek personal specific advice before making any decision. Ken says, thanks, hope to be back next time for the info on CGT, etc. Your pleasure, Ken. Thanks for joining us. If there's no other questions coming through, I might finish up there. So thank you for all everyone who has actually stayed on throughout the presentation. You must be pretty keen staying up until 10 past 10 Australian Eastern Standard Time. So appreciate you joining us. and hopefully we can catch you at future webinars. Thanks, Eddie. Fiona, just got a quick question at the end there. If you are on the TTR pension and still working, then when you turn 65, do you have to stop working and be automatically put on the full pension? When you actually turn 65, your TTR pension turns into an account-based pension, so it moves from being a 15% taxable to tax-free earnings within the pension phase. But what's the other? So then, when you turn 67, do you have to stop working and be automatically put on a full pension? I think the other part of your question, Fiona, is so accessing the tax-free pension phase of superannuation. There's a catch-all at 65 years of age. The 67 years of age is the pension age for somebody who was born from 1957 onwards. To access the age pension, you need to apply for it. You don't get it unless you apply for it. So generally, if you're eligible for it on or slightly before your pension age, you apply for it. And if you're eligible based on the income and assets test, you'll start to receive the age pension. Let us know if I haven't answered that question fully there, Fiona. Adrian, good work. Thanks, Adrian. Appreciate the positive feedback. And David, thanks. Very helpful. Pleasure, David. Thanks for joining us. And Fiona, thank you. Hopefully I've answered your question properly there, Fiona. Just respond quickly if I haven't. And I can answer you now. Otherwise, I'll sign off and tune in. We'll be back with you again for the next webinar, I think on the 11th of September. Other resources, all these webinars are on cornerstonewealth.com.au/retire 2017. We'll email you the webinar recording. The next webinar is the how to reduce capital gains tax and maximise your estate on the 11th of September. We can give you personal financial advice if you contact us via the website or call us, and then Christian Super's help desk or the website is available for further info as well. So thanks again for your participation and good night.